Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to be talking about how to invest in bonds in a rising interest rate market. So this is a question I get thrown at me all the time. We'll lean on Chris Richard at BCV or other investment professionals that we work with to help answer this question. But in general, when interest rate rises, bonds will fall. Okay, so do you want to own bonds right now? Well, interest rates are probably going to be creeping up. So, bonds may not be the best strategy, but there are ways to buy bonds, have a decent return, and be protected a bit against rising interest rates. So we're going to cover off that today. We interviewed Chris Richard from BCV Asset Management, Inc., and he's going to talk about how to invest in fixed income and bonds and fixed income strategies in these markets. And they're a bit of a different market than we've ever seen before. We're at rock bottom interest rates. They're probably going to start creeping up. So how do we manage that, maintain that, and make sure that the foundation, the fixed income of our portfolio, isn't going to kind of fall out on us? So this is the fourth video we've done with Chris. If you've enjoyed these videos, make sure to hit the thumbs up and also leave a comment below. If you'd like us to do more videos with Chris or other portfolio managers at BCV, leave a comment below on what you'd like us to do those videos on. So we're probably going to launch a bit of a series on ESG investing. So we'll go through that, what that looks like, how that has evolved in Canada and the US from right across the world. So we'll do one of those videos, or a few of them probably. But if you have any other ideas or videos that you want to see, leave a comment below and we'll add that to the list, and we'll try and get those videos out shortly for you. Chris Richard is a portfolio manager that works for BCV Asset Management, Inc., a registered portfolio manager, investment fund manager, and exempt market dealer that is independent from Parallel Wealth Financial Group, Inc., but works with referring advisors, much like myself, to provide discretionary portfolio management services to our mutual clients. So Chris, in this video, I just want to talk about kind of interest rates and bonds, and kind of, we've always said you have to have bonds to create that foundation of the portfolio, but with interest rates at record lows, bonds, returns essentially at record lows, many of our clients would be invested in bond funds, whether it's through the bank or an online platform. So I just want to talk about, you guys do bonds very differently. Anytime you guys have sent, a bond proposal to a prospect of ours, they've been blown away with it. So I just wanted you to kind of walk through that process, how you guys manage bonds, how, bonds, interest rates, inflation, kind of just tie that all together, just so our viewers have a better idea of what to look for in their portfolio.
Sure. And Adam said I had 5 minutes. So bonds and interest rates, right? So coming off of COVID-19, I mean, we have seen interest rates around the world come down to generational lows, right? We're at very low rates right now. And if you hold a government of Canada bond, a US Treasury, right, it is safe, right? Do I ever see the government of Canada defaulting on an instrument that they've issued to the investing public? No, right? When you own the printing press for money, difficult to go bankrupt, right? Very difficult. But what can happen is, as interest rates normalize, you can have a negative price experience in fixed income, right, in bonds. And for us, what we do is we focus in on and say, like, investing in government bonds right now probably doesn't make a lot of sense, right? Inflation is kind of coming, and we don't want to be locking in clients for a long period of time at rates which we don't think are sustainable. So what we do at BCV is we focus in on corporate bonds, right? And I know some people think corporate bonds, that seems, more risky. And over government of Canada bonds, yeah, everything's more risky, right? But what we focus in on is great businesses that are primarily investment grade that just need to raise money, right? And we focus in on bonds that mature, no longer than 10 years out. And we want to focus in on companies that have got strong fundamentals, right? So the bond market and having access to that for the DIY investor, it's difficult, right? It's very, very difficult. And then you're kind of left in these bond funds that, majority of them have a lot of exposure to longer dated government bonds, which we don't think makes a lot of sense right now. So we have relationships with a lot of bond dealers, and we have the ability to buy directly from them. And we're able to, get a competitive price in bonds that we like. Again, same like when we were talking about stocks earlier, we're really focused on holding bonds of higher quality. but we also want to make sure that we're getting paid. When we talk about bonds, we want to get a return on your investment and a return of your investment. The bonds are a ballast for the portfolio, right? A nice, stable cash flow generating return. Can they bounce around in price? Yes, right? But for the most part, we're investing in companies that have got strong fundamentals that just need to borrow money. And we think that holding those bonds that pay oftentimes a lot more than government bonds, is a good risk reward for clients over the long term.
No, it makes sense. And I think a lot of people we talk to, I'll give you an example actually. So just recently this week, I got an email from a family member, has a GIC coming due, and I did a video on this a while ago as well. But GIC coming due, what do I do next? And it was, her contacted the bank or whatever, said, you can buy a bond fund, and it's, it yields 3.5, has a 1.5% fee, so you're going to get 2%. And the reality is, I told her, like, yeah, but the price of the actual bond fund can fluctuate, which a lot of people don't understand. I said, depending on what interest rates do and everything else, like, you could end up actually losing money on this bond fund. So, I think a lot of people, if you go to your bank or you do kind of online investing, whether it's, Wealthsimple, wherever, it doesn't matter where it is. If you're buying kind of a managed portfolio like that, you're getting thrown into these bond ETFs or bond funds. And I think there's more inherent, just talking to you and going through this content you're talking about here, there's more inherent risk or more actual risk to owning that bond fund than people actually realize. And it can be almost a drag on the portfolio at some point.
Yeah, I mean, people, like, we've been in a declining interest rate environment for like the better part of 30 years, right?
Mm-hmm.
So, we've kind of hit, I'm not going to call the bottom, right? But we are at low rates right now. And going forward, are very few clients that I come across and work with can make their portfolios make sense, performance-wise, at an interest rate that is a Government of Canada 10-year bond rate, right? Which is at very, very low rates. Unless you're phenomenally wealthy, it's very difficult. Why clients want fixed income is because they're drawing cash flow out of the portfolio, and they want to have kind of that more stability than exposing their entire portfolio to the equity markets. But how do you do that, right? People can buy within Wealthsimple, within their bank. They can buy individual shares of companies. That makes sense, right? If you're buying stock, people can usually do that. Fixed income is really a complete other beast. It tends to be more of an over-the-counter market, right? It's you have to go to the bond dealers, and for the most part, I don't think, and thinking through, I don't think I've ever seen a DIY portfolio hold individual bonds, right? It's difficult to do. And what they do is, you're right, they end up buying a bond fund. And oftentimes that bond fund holds everything, right? They'll hold one of everything in there. And when you look at the index, it's, most of the bonds would be probably government bonds. And currently, as we kind of come out of, a depressed interest rate cycle and inflation perhaps is gaining some steam, longer bonds might not be a great return over the short to medium term. We want to focus in on businesses that, pay you a nice healthy coupon, that are not overvalued. And we want to just make sure that we're focusing in on fundamentals of these businesses. Like I said before, return on your money and a return of your money is our focus on fixed income. If we ever wanted to add more risk to a portfolio, we buy more stock, right? Because the upside with stock is the moon. With fixed income, it is in fact fixed, right? At the end of the term, this bond is paying off and is going to return you your capital. But if you kind of look into 2020 and what, say a 30-year Government of Canada bond has done performance-wise, if you bought that in, say, mid-August of 2020, look at the price difference there. You would have had a huge decline in that face value. Again, in 30 years, Government of Canada is going to pay you back your principal, right? But over that time period, if you want to sell in between there, your performance is not going to be great. Yeah. So what we focus in on is making sure that we're not buying companies or bonds from companies that are too far out into time to maturity. We're focusing on companies that are paying you a healthy amount for the relative amount of risk that you're taking. And we also want to really focus in on businesses that are just happen to need to raise money, but check a lot of the boxes that we look for in equities, to be quite honest with you, right? Do they have a strong management team, strong cash flow? Those characteristics usually lead to a good investment. We're very selective on what we buy, right? We're not going to, again, hold the universe because, again, same thing with stocks. Some bonds are, in my opinion, overpriced. Some bonds, in my opinion, are underpriced, right? And that's where we go as a management team, as a investment committee, is we say, like, there's what we want to hold, right? Here's the best investment we can make for clients.
Yeah.
And, clients have been happy, investing this way.
Yeah. And so just be clear for viewers, like what BCV does is they actually buy individual bonds. So they're not buying a bond fund for client portfolio. So they might own, I don't know, 5 to 10 individual bonds. So, it's a very different structure than going out and buying a bond fund. So you just want to kind of preface that. But anyway, Chris, thank you so much for kind of going through that, how bonds work, how as much as they are kind of the stability of the portfolio, if not done right, they can actually be a detriment to your portfolio. So it's good for people to know. Again, if you want to learn more about BCV, about Chris, what they do, how they manage clients' money, in this case, how they buy bonds for clients, send us an email, info@parallelwealth.com, and we'll get you connected with Chris. Thanks so much for joining us.